Good morning and welcome to the Share Series Monday Management Update. I'm Dan Aldridge, founder of the Share Series, and today I have the pleasure of speaking with Kress, the CEO of Shapeways. Before we get started, be sure to use the question button at the top of the video player to submit questions throughout the session. And so with that, I'll turn it over to Greg to get started. Greg?
Yeah, thanks everyone for joining us today. I'm really excited to talk to you. To give you a little bit of background about myself, my name is Kress. I'm the CEO of Shapeways. I've been leading the business for about 5 years. We've been a public company for about 18 months. We went public through a de-SPAC process. And what we'll do today is we'll talk you through our management presentation, and then we'll leave some time for questions and answers kind of at the end. So let's jump right in. If you could just progress a couple slides. And then next slide. Perfect. Let's start off with the high level. What is Shapeways? Shapeways is a digital manufacturing platform. We offer our customers the ability to get access to on-demand and scaled manufacturing services. And that's really powered by our purpose-built proprietary software. And what that does is it allows for really complex manufacturing to be made simple. The second thing we do is we leverage that software platform that we have internally, that we run and operate our own manufacturing facilities with. And we provide that to other small manufacturers to give them the opportunity to digitize their own business. And what that does is it allows them to unlock growth opportunities and drive revenue growth. It allows them to remove waste and unnecessary costs and drive profitability, and ultimately allows them to expand their capabilities and meet more of what their customers' needs are. If you move forward a slide. And so before we start, I'll kick off with some investor highlights. One, we're really going after a multi-trillion-dollar global manufacturing market. And this market is known to be slow, non-digitized, very manual, and focused on mass production. And what Shapeways is doing is we're really focusing on the shift that's taking place in this space by helping that manufacturing process really digitize. The second point is we're a proven high-quality, flexible demand digital manufacturing service where we've produced over 24 million unique parts to over 1 million end customers. So a lot of proven size and scale. 3, we've also seen incredibly strong enterprise manufacturing customer growth, and that's our ideal customer profile that we're going after. These customers not only come with more recurring lines of business, but also very attractive economics. Point 4 is, we're highly differentiated versus others because we have invested the time and energy over the last 10 years to really digitize the end-to-end manufacturing process. And so that software platform really allows us to achieve higher levels of profitability and lower costs, which allows us to transition lower pricing levels to our customers and allows us to win in the market. Point 5, we have a very clear path to profitability. We continue to drive revenue growth, optimize our gross margin, maintain a tight cost structure, and that allows us to continue on that path to profitability. And we'll talk about this later in the presentation, but it's really fueled by our progress that we're making on our software adoption and then also on our enterprise manufacturing solution. And then the last point I would make, we have an incredible team around the table, which includes not only our highly invested, experienced management team, but also incredible investors that not only participated in our venture rounds, but all have maintained their ownership as we became a public company. So that includes Andreessen Horowitz, Lux Capital, Union Square Ventures, INCEF. And so we're very lucky to have a great group of investors around the business today. Go to the next slide. So let's start with the market. One, this is a massive market, but it has a big challenge. It's known to be very slow, manual, and rigid. It's focused on mass production. And what we see is a constant change of customer needs. And what that really holds this market back because it can't adjust to those needs quickly. In very traditional manufacturing processes, it may take years to go and change and meet those changing customers' needs by the time they resource molds and rerun manufacturing facilities and drive injection molding. And what we're doing is by digitizing that end-to-end manufacturing process, we can shift very quickly. It allows us to get access to a wide range of manufacturing technology, but also it allows us to use the software platform that we run our business with to really achieve higher speeds to market, much lower costs, and a lot more higher flexibility. Go to the next slide. So we're very well positioned for profitable growth, and it's really driven by two things. The first part of the presentation, we'll talk about our enterprise scale digital manufacturing service. So this is the actual manufacturing of parts that we do for our customer. On the other side of the presentation, we'll talk about the digital manufacturing software platform. And that's the software platform that we use to go run our own business, but we're also making available for other small manufacturers. So if we move forward. The first thing we'll talk about is those digital manufacturing services. So next slide. So just to give you a high-level overview of what we do today, we really provide our customers this on-demand manufacturing service. And it allows them to get access to high-quality manufacturing with really extensive additive manufacturing capabilities, because that type of manufacturing process really leads itself to be a good fit for this type of manufacturing. We've produced 24 million unique parts. We don't produce millions of one part. We're literally producing one part at a time for our customers. And we've done that using really 12 different additive technologies and over 120 different materials and finishes. And we're doing that with incredible metrics, with less than 1% complaint rate from our customer base and 98% on-time delivery. Next slide. And the way we're able to accomplish that is really by leveraging our software platform. And what we've done is we make complex manufacturing simple by really digitizing that end-to-end manufacturing process. And so let's talk about the 5 components of the software platform that we have today. The first component is our ordering platform. This allows any customer to come to one of our sites, upload their file, configure it across their manufacturing needs, get instantaneous pricing, and create a digital inventory that can be integrated back into their various selling sites or their ERP system or whatever they're using to go run their own business. The second thing we do is we have an analysis platform. This allows for instantaneous printability checks to drive higher levels of manufacturing ability. It allows for file analysis to see if that file is actually manufacturable. And it also has file optimization workflows where our team on the manufacturing floor actually communicates back to the customer to make optimizations when there might be a need for a change to the part to allow for higher success rate in the manufacturing process. The third thing our software platform does is it really focuses on the manufacturing planning aspect. This allows our customers to gain access to our full supply chain capabilities. And so we look at the 6,000 unique parts that flow into our manufacturing facilities a day, and our software makes the decision of where those parts should be manufactured. And what it does is it does that through the lens of what's the capability of the system and what's the capacity of the system to really optimize the gross margin or gross profit that comes from each part individually. The fourth piece of our software is really our pre-production software. And this is where we're using software to look at that massive backlog of work in progress and identify which parts should be able to go into the very next build. And one of the things we focus on heavily at Shapeways is really revenue per millimeter. And the reason why we do that in our manufacturing process is because we have a relatively fixed overhead structure. We have a fixed cost model associated with our assets that are on the floor. We also have, relatively fixed labor. The only thing that really shifts is really our material costs. And so when we really push as much volume through our system as possible and really leverage the economies of having this wide range of customer parts coming through our system, we're able to get much higher levels of gross margin. And then the last piece of our software is our manufacturing workflows. And this really allows for every single part to go through very complex workflows in our system. It's all driven off of a desktop or a mobile device. It allows you to move a part from step to step. We have 100% traceability on all things that took place with a part. So of those 24 million parts that have gone through our system, I can tell you exactly where those parts came from, what machines they were printed in, what material lots they came from, and then every single step of the process and the key metrics associated with that. So we know how much time it took from step to step. We know where there was reprint issues or quality issues. We know what labor touched the various aspects of the steps. So it just allows for a tremendous amount of data optimization over time, where we can use that data to get higher levels of profitability in the future. Next slide. And so what this creates is really an AWS-like offering for the additive manufacturing space. And it's just so just like AWS took servers from the office space and moved them up into the cloud, we're doing the same thing with additive equipment. And what that does is it allows you to get access to additive manufacturing parts in days. You can upload a file, we can print you a part and deliver to you within 24 hours. Very scalable solution. So you can scale up and down based on your business needs. And so you can flex that up and down depending on seasonality or what you may see as success inside of your business. Very low cost upfront investment. We don't require any large upfront minimum order quantities or upfront investment, and ultimately it gives you access to a very high quality, flexible, sustainable manufacturing process. Next slide. And what we've seen over the years is consistent growth of our target ideal customer profile, right? Of our top 250 customers, we've seen 18% revenue growth over the last several years. And these are customers that are coming back to us again and again, expanding their book of business and really leveraging Shapeways as a differentiator for their manufacturing. On the flip side of that, not only are these customers growing with us, but the profitability of these customers are actually growing faster. And so what we see is these customers leaning into newer technologies, newer materials and finishes, a lot of upsells, and it allows us to continuously drive higher levels of economics from those customer base. Next slide. And here's a few customer examples. Microsoft has entered into an agreement with us where we have a massive digital inventory of parts. And those parts basically are adapters to all of their physical hardware that Microsoft sells. And so if you want to have some level of an adapter to drive higher levels of accessibility for someone with disabilities, you can go onto Microsoft's site, you can configure that part across the millions of various digital inventory parts. We manufacture that part on demand and deliver it directly to your end customer, right? The second example we have is we've been the partner for Dragonfly. This is a combination of NASA and Lockheed Martin, where they're creating a drone program. And we're manufacturing a lot of plastic and metal parts for their drone program that they're developing. And then lastly is Whirlpool. Whirlpool, the image at the bottom of the screen actually is a metal part. It's a mold for an injection molding facility. And what we've been able to do is we manufacture that mold through additive manufacturing. And what we can do is drive it's called conformal cooling, drive very precise cooling chambers through that mold so that as that mold cycles parts, it can cool significantly faster. And this mold specifically actually had a cool time of about 40 seconds. We've reduced that to less than 8 seconds. And so what you're able to do is get dramatically higher levels of yield through your manufacturing process with the same cost basis. And so it allows for injection molding to become much, much more profitable. And we're seeing significant progress across various industries, but very specifically industrials, where we have a lot of things that we're helping other manufacturers do, and robotics, aerospace, all unmanned aerospace applications. So think space or drones, automotive. We're seeing a tremendous amount of progress, specifically with the adoption of what the tier one automotive suppliers and the big OEMs are moving towards. And then lastly, the medical industry. We specifically do things out of the body, but we have some incredible customers that are doing very unique things and we're supporting them on all of their manufacturing processes. Next slide. And so let's switch gears and we'll talk a little bit about the software platform that we have now commercialized and are now providing to other manufacturers. Next slide. And so we've branded this under the brand Auto. This allows us to have some separation from the Shapeways brand, where those small manufacturers don't see any real risk to really compete against Shapeways. But really what it is a comprehensive manufacturing software suite. And what it does is it allows these small manufacturers to use relatively simple tools that Shapeways has kind of simplified for them to really digitize their end-to-end manufacturing process. And this starts with the ordering process and allowing them to manage their They're everything from the receiving an RFQ to quoting an RFQ to processing that through the end-to-end manufacturing facility, and then leveraging a supply chain. So it allows them to grow their revenue, increase their profitability, expand their manufacturing capabilities, and really increase customer satisfaction by moving online and really digitizing their process. Next slide. Now, to bring this software offering to market, we tested multiple different channels. What we found was one of the channels that had the least amount of friction and had probably a really strong return on investment was really a platform called MFG. We acquired this platform about a year ago. This platform comes with about 120,000 small manufacturers that are active on the platform, and they use it for a very basic storefront for their business to really showcase their capabilities. Think of it as a very basic marketplace. But it's our ideal customer profile. And so what we've done over the last year is start to deploy the auto software offering to those customers. And so far, there's been 4 things that have deployed fully. One is demand services, where we help them capture RFQs and bring in demand to their business. The second is the ordering process, where they can actually communicate back and forth with the customer, quote that order effectively, and then process POs, invoices, and the transaction right on the platform. This all integrates directly into their QuickBooks. And so it allows for a very streamlined, simplified process on their side. The third aspect is we deploy transactions. We now allow them to take ACH, wire transfer, and credit cards on the platform. And what this does is it creates an additional revenue channel for Shapeways. So not only are our customers paying for the SaaS model associated with this operating platform, but when they use transactions, we capture 1% of everything that flows through that transaction model. And so it creates another very highly scalable revenue line on top of the business. The fourth thing that was deployed was really part tracking. And so this is the way for them to create very complex workflows to manage their manufacturing site and really move parts from step to step, communicate with your customer, and really drive waste out and increase your quality. What just went live, and we're currently still scaling it, is what we're calling materials and supplies. What we've done is we've negotiated large discounts with raw material suppliers and supply companies that are needed for small manufacturers. And what we're doing is we created a marketplace where we can offer up those supplies at a discount to our customer base when they need them, right? And so this has actually seen a crazy amount of traction. We're really excited about it. And this allows for another revenue line for the business, right? We're now capturing about a 5% commission on everything that flows through this, because we know that, our small customers that are doing, $2 to $5 million worth of revenue a year, 20% of that goes directly to raw materials, right? And so if we can broker that deal on their behalf and provide them with discounts, we have the opportunity to create another revenue line for ourselves. And then lastly, this is more on the radar for Q4 into Q1, supply chain capabilities and logistics. And so it's really allowing them to leverage the other platform users on the platform for their manufacturing capabilities, including Shapeways, and then also logistics for us to help them really negotiate better logistics pricing on their behalf. And so next slide. And so what you see here is a ton of momentum. We really started pushing on our acquisition funnel in Q1, and we saw 56% Q1 SaaS bookings growth quarter over quarter. We saw even higher levels of bookings in Q2 and as we move into Q3. So we're seeing really strong momentum. Now, obviously, this is all the SaaS bookings growth. So these bookings get translated over the next 12 months from a revenue recognition perspective. But overall, really, really solid base of customers that we're bringing in. We're now approaching over 1,000 active paying customers on the platform. So we're excited about that. Very, very low levels of customer churn. So we're seeing high levels of retention. Customers are using the platform. We feel like they're getting a lot of value out of it. And then if we look at just the first 12 months, the expected revenue coming from a customer right now is over $4,200 just for the SaaS platform. That doesn't include any additional materials or transaction revenue that's coming in, just because we're not providing that information to investors yet, because again, we're still within the first 3 months of some of these products being rolled out. Next slide. And so let's talk a little bit about the third focus. It's all about profitable growth for us. Like, how do we get to profitability? So next slide. It really comes down to a handful of things. We are focused heavily on, driving to profitable growth. And it comes from a handful of things. One, driving revenue. Obviously, we have a revenue plan in front of the business. That one, software tools and services continues to show that great growth. The good news is the revenue associated with this business is pretty reliable, because we're just translating the bookings that we've already taken into revenue as we look forward. Second is really continuing our strong growth on the enterprise manufacturing side. We're seeing 20% CAGR roughly. And, we closed 4 really large contracts in Q2. 2 of them were automotive contracts that'll deliver $2 to $3 million a year for the next 7 years. There was another 2 healthcare contracts that'll deliver between $1 and $2 million a year for the next 3 years. So we're feeling really good about not only the pipeline, but also the contracts that we see looking forward for this part of the business. And then thirdly, our legacy e-commerce manufacturing channels. Obviously, this is the lowest gross margin business. It has the most price sensitive customers. I would say it's one of the harder ones to grow, but we really don't need that business to really grow substantially. We're really just expecting that business to really just run forward as it is. The second piece is really improving our gross profit. Right now, we're roughly around 40% gross margin. We have consolidated our 2 U.S. manufacturing facilities in Q1 of 23, obviously, and there was some spillover into Q2. But, as we look into the back half of the year, we're going to be able to reap a lot of the benefits of doing that. We also start to see a business revenue shift right towards software, which software is now trading at 90 to 95% gross margin. And so that has a disproportionate impact on our gross margin. And then we continue to see that we have pricing opportunities in this market. There was a few players that over the last several years had made some pretty poor pricing decisions that had hurt the overall industry. But those players have done big corrections, and it actually puts us in a good place. We're also continuing to look at reducing our operating expenses, constantly focusing on optimizing our headcount and enhancing our operating structure. But we see a lot of opportunities to move forward, specifically around public company expenses, because most of the companies that were small that went public via a SPAC had very high first 2-year expenses. We continuously see those expenses going down. And lastly, we're just being very sensitive around our cash balance, to be very thoughtful about where we allocate that capital to get the highest return on investment. Next slide. So before we jump into questions, just to highlight, why we think this is such a good investment for investors. One, we're shaping a massive global market, tons of opportunity for digitization. We're probably one of the largest players in this space. There is no one that has really done what Shapeways has done from a breadth and scale standpoint in additive manufacturing. Very strong enterprise manufacturing customer interest pipeline and transition into contracts. And so we see that looking very good as we look forward. Highly differentiated software platform where nobody is really doing what we're doing. And I think now that we're applying that and commercializing that software to other small manufacturers, the opportunity is just huge. We have a clear path to profitability. We continue to work on it every day. And then we have a great group of investors around the table, and we're always looking to add new investors, new good investors as well. So with that, we can turn it over to questions and go from there.
Awesome. Appreciate the overview, Greg. Fascinating company. I mean, it appears like you guys have done a ton of work, or really at an inflection point, right? And so at this point, what do you think that investors, the street in particular, is not appreciating in the story? And from your perspective, what's it going to take to get there?
Yeah, that's really the elephant in the room, right? Like if you look at our market cap today, we're highly undervalued. I personally feel like there's a tremendous amount of value in the business that investors don't fully understand. And it's really driven off of a couple of things, right? If you look at most companies that went through the SPAC process and de-SPACed, they're trading in a very similar way as Shapeways. And there's a lot of reasons for that. One, half of those companies probably aren't really great companies at its core, right? I think Shapeways is, right? Shapeways is, it has a strong base of revenue with good customer growth and a highly differentiated offering. So I think, one, customers or investors really need to get over the hump of like looking beyond that de-SPACed kind of overhang is what I've heard investors call it. And so once we get through that, I think that's important. The second is we're in a very risk-off market, and I'm a micro cap company that's still burning capital, right? And so when we think about investors, I think the investors that are probably listening to this right now are probably a perfect demographic of investors that are looking for this, right? Because there's a huge opportunity for investment in micro cap right now because it's really been maybe underutilized as an asset category. And so like there's a lot of pressure on it. And I think that there's a lot of opportunity for a lot of investors to make considerable returns as the market returns and you start to see people move away from this full risk off position.
Yeah, I completely agree. With where we are with the market right now, I think a lot clears up as we get into next year, right? And assuming you guys hit those profitability numbers like you've laid out, I think that does change perception a good bit, and some of the uncertainty goes away. So let's talk a little bit, about that. And so you're anticipating positive EBITDA, the inflection in 2024. What gives you confidence to get there? What gives you confidence in your liquidity position now? And what do you think, if any, that you would need more cash for in 2024?
Yeah. So we have a strong cash balance. I think one thing that investors should be aware of is in Q4, Q1, and Q2, there were some non-recurring cash expenses that took place in the business, really driven by two things. One was the site consolidation that we talked about earlier, and that has, a solid 18-month payback, but in general, it was cash outlay for the business that hit us over multiple quarters. And the second was we acquired two businesses, MFG and a business called Linear AMS. It was a small business in the automotive space that did digital manufacturing, specifically metal printing. And both of those had earnout structures associated with the transaction. So those earnouts were paid out during that time period. And so those are all behind us at this point, and now we're operating the business moving forward. I think, what investors should see is quarter over quarter improvement in our cash burn as we continue to drive revenue growth across enterprise and software. And we're constantly looking at ways to further optimize our operating expenses. And so as we do that, you should be able to see that start to overcome, and you see this path to profitability pretty easily.
All right, we've got one coming in from the audience, and this one is really around customers' revenue generation. And so what does a contract size-wise need to be to really move the needle? From a revenue perspective. So you talked about NASA, Microsoft, great customers, but what is the kind of size of contract, average contract look like, and what would you deem as a kind of material contract?
Yeah. So from our perspective, the real value proposition of Shapeways is not this long-term contract. That's where you'll see very, very low margins. Well, what allows Shapeways to capture these very high levels of margin is allowing customers to really have more of an on-demand application. So most of our contracts have price breaks associated with them as you get higher and higher levels of revenue or volume. But in general, the customers that we're really looking for are customers that are really making purchases, 15 purchases, 20 purchases a day, right? We never want anyone to batch an order. We never want anyone to wait until they have a certain size of volume. We really want to be integrated directly into their ERP system so that as they're sending business to Shapeways, right? Now, with that being said, there are customers that do want to sign up for these larger customer commitments, and that allows us to offer them better pricing. It allows us to make investments on their behalf. And there was a few of those that I kind of spoke about earlier, right? Where, the two automotive contracts that we signed in Q2, both of those contracts combined will deliver, potentially on the high end up to $4 million, maybe even more a year, depending on how they continue to scale their business. And that's a contract for the next 7 years.
Okay.
So it's a good amount of revenue that we made that we noticed. And one of those is directly with an OEM, and the other is with a tier one automotive supplier. The other contracts that we made reference to during the presentation were two big medical brands, and one of them does basically surgical guides. And so they take an MRI scan, and we do hips, knees, and spine surgery applications with them, where we'll print 30 to 40 spines a week with surgical guides that go onto the spine. We deliver that directly to a surgeon. The surgeon then use that for pre-surgical testing, and then they use the guides for the actual surgery. And so what we do, it's all out of the body. Nothing's left in the body, right? It's really just to make that surgeon a lot more effective. And like what we're doing is not only have we taken over one region for them, we've now scaled to multiple regions. We now brought on multiple product lines, and that could be, that could deliver a couple $1 million of revenue a year. And right now we're on a 3-year contract with that customer. And so there's some really, really interesting applications that are taking place, but they vary widely, right? Because we have offered this on-demand wide application, it doesn't really have the exact same customer again and again. It really has a very wide use case. But what is consistent is this idea of highly complex manufacturing using state-of-the-art industrial grade additive manufacturing that's really powered by our software platform.
So we got another one coming in from the audience. This one's really around competition. You mentioned, right, that you're probably one of the biggest players in the space and no one's like you. But for investors, right, who would you compare yourself to if they're trying to find a comp?
Yeah. So two big on the manufacturing side, there's two big players that are public companies today. One is Proto Labs, the other is Materialize. Those are great reference points to take a look at. They do very similar things that Shapeways does. Proto Labs is a lot more traditional manufacturing. I'd say over 90% of their business is more traditional versus Shapeways. But then Materialize does have a lot more additive in volume, very similar to a Shapeways. And so those could be great reference points on the manufacturing side. Now, with all that being said, we're talking about a multi-trillion-dollar industry. The real manufacturing competitors is really your small mom and pop shops, right? They're small. There's millions of them in the US. They do 2 to 10 million in revenue a year. And they are very highly localized with their customer base. And, they make up a very large percentage of what is being manufactured out there. Now, on the software side, there's really no one doing what we're doing, right? We're creating what I would reference for investors is think about what Toast has done for the restaurant industry, right? And Toast is an operating platform that allows any small or restaurant to basically digitize their operations end to end. It creates an operating platform for them. It allows them to take point of sale and from a fintech revenue perspective, it allows them to take a SaaS model across the entire operating platform. It allows them to help manage reservations and staffing and supplies and all of those things right in one. And we're doing a very similar application for small and mid-sized manufacturers.
Fascinating. So we're coming up at the end of time. And so where I'd kind of love to leave it is first, thank you for coming and participating. It's been a fascinating conversation. I can think of a million other holes we could go down, right, to discuss in the future. But as we kind of close, right, what should investors look for, right, from Shapeways to gauge your progress?
Yeah, I think continued execution. I think our strategy is spot on. It's about our execution over the next several quarters, right? I would encourage everyone to take a hard look at the stock. If you're interested, we can always do follow-ups. But again, our execution on revenue growth, gross margin improvement, and continuing to optimize our OpEx gets us on that path to profitability, which I think is what investors are looking for. And so as we continue to do that, I think there's a tremendous amount of upside for investors in the stock. And so I would encourage everyone to take a look. And if there's any follow-ups, please let us know. I'm always willing to jump on a call.
Awesome. Thanks, Greg. And thank you, everybody, for participating today. Up next at 11:30, actually at 11, is going to be Virios Therapeutics. Thank you. Goodbye.
Thanks, everyone.